Imagine you had $10,000 invested for 20 years. And you were smart, you dodged the worst days. But you also missed just the 10 best ones. That single mistake would have cost you more than half your money. I've watched investors do this for 50 years. They sell when they're scared. They wait for the right moment to jump back in. And that moment never comes clean. So they sit in cash while the market runs without them. Today I'm going to show you the actual numbers from J.P. Morgan, from Nobel laureates, from decades of investor behavior. And the third lesson is the one that quietly destroys more portfolios than any recession ever has. Right, the market beats timing the market. Here's the study that should end this debate forever. J.P. Morgan tracked the S&P 500 over 20 years, ending in 2022. If you stayed fully invested, $10,000 grew to $64,844. That's 9.8% a year. But watch what happens when you step out. Miss just the 10 best days, and you're left with $29,000. Miss the 20 best days, $17,000. Miss the best 60 days over 20 years, and you actually lose money. You end up with 4,260 days. Out of roughly 5,000 trading days. Miss the tiny handful, and 2 decades of growth just evaporates. So the obvious question is, can't I just avoid the bad days and keep the good ones? And that is exactly where it gets interesting. Here's what nobody tells you. The best days and the worst days are neighbors. They sit right next to each other. J.P. Morgan found that 7 of the 10 best days happened within just 15 days of the 10 worst days. Draw, worst day then arrow then best day labeled often within 2 weeks. Think about March 2020. COVID hit. The S&P 500 crashed to 2237 on March 23. Terrifying. Everyone was selling. And the very next day, March 24, the market jumped over 9%. One of the best single days in history. So the investor who panicked and sold on the 23rd? They locked in the loss and slept through the recovery. The pain and the gain came less than 24 hours apart. Sketch, panic sell at bottom then miss plus 9.4% rebound then buy back higher. You can't cherry pick the good days without risking the great ones. They're a package deal. And here's the part that still surprises people after 50 years. Back in 1975, a Nobel Prize winner named William Sharpe ran the numbers on market timing. His conclusion? To just break even against a simple buy and hold strategy, a market timer needs to guess correctly about 70% of the time. Not once. Every single time in and out, in and out. Right, you have to be right twice. When to sell and when to buy back. Nobody does that consistently. Not the pros. Not the hedge funds. And definitely not the rest of us checking our phones at midnight. And the proof is in how real investors actually perform. The research firm Delbar has studied investor behavior for decades. And year after year, the average investor dramatically underperforms the very funds they own. Why? Because they buy high out of greed and sell low out of fear. The gap between what the market returned and what investors actually earned is called the behavior gap. And it's brutal. This isn't about intelligence. Some of the smartest people I know are the worst investors. It's about temperament. The market is designed to transfer money from the impatient to the patient. So here's the one principle to carry with you. You don't need to predict the market. You need to survive it and stay invested through it. The greatest gains in your lifetime will arrive on a small number of unpredictable days, and they'll almost always show up right when everything feels the worst. Right, don't time the market. Give the market time. Time in the market beats timing the market. Every single dataset agrees. This is educational, not financial advice. Always do your own research, and remember past performance never guarantees future results. But the historical record here is about as clear as investing ever gets. So let me ask you, have you ever tried to time the market? Did it work out? Be honest in the comments. I read them, and your story might save someone else from the same mistake. If this changed how you think about patience, hit subscribe. We do this every single day. And tomorrow, we're breaking down the one number Warren Buffett checks before he buys any stock. You won't want to miss it.